Good morning, traders and investors, and welcome to our Wednesday live stream show. I'm your host, Bennett Tyndall with TradingAnalysis.com. Hey, a lot's happened in the market since we last met at the end of November. We do apologize for not having a live stream show last week. We were having some technical difficulties with our internet connection here in the office, and we're unable to maintain the upstream and the downstream that we needed. So we do apologize for that. But hey, let's jump into it. We've got a good show planned for you this morning. We've got Mr. Todd Gordon of Inside Edge Capital joining us from the Advisors Corner. We're going to quickly take you through the indexes briefly before we bring in the team. Just going to take you through the S&P, take you through the NASDAQ. We'll talk about that corrective retracement, and then we'll jump into it. So give us just a second here, and we'll jump in to the charts. Good morning once again, and thank you guys for tuning in. Hey, let's jump into it. Hard right edge of the Motive Wave platform. And for those of you who were with us Thanksgiving Eve, I discussed a giveaway. I'm going to be giving away one of my Elliott Wave fast track courses. If you did subscribe to the channel at the last live stream, do me a favor and comment below subscribed. We're gonna throw you guys into a random number generator next week and do a giveaway. So let's hit it. Taking a look at the S&P 500, we are going to start on the daily chart and essentially take you back to the COVID low. And I continue to view price action from the COVID low as still being contained within the same degree of trend. We discussed a couple of months back, maybe 6 weeks or so, the subjectivity of the NASDAQ and the S&P's wave structure from that COVID low. However, when looking at some of the other indexes and sectors, including S&P mid caps, Russell 2000 small caps, those charts leave us with fewer possibilities in terms of the actual wave structure and the wave count. So I continue to view price action as still contained within the same degree of trend, which simply means that we should anticipate perhaps mid Q1, end of Q1 next year. That's where I'm looking for possibly a larger corrective retracement. All that tells us is that it's going to exceed the magnitude of anything that we've seen since the COVID low. Does that mean we're going to see a massive 50% retracement? Absolutely not. In fact, I've taken you back to the weekly chart numerous times, and we reviewed the higher degree trend retracement percentage levels, and at this point, I don't see that as anything to fear. I continue to remain bullish in the longer term view. So let's get into it. We're going to go hard right edge of the upper right hand corner of your chart. We're looking at the daily. We're going to go ahead and zoom in here. And when we met last month, the end of November, we discussed two key possibilities in terms of the price structure from the October 3rd low. Based on what we've seen the past couple of days in the market, that being about a 78.6% retracement of our recent decline from the November high, there's a strong possibility that this wave 2 is in fact complete. Looking at price action, we're going to take you off of the daily and take you right to a 195-minute half-day chart. We'll go from the 195 to the 1 hour. You can see that same circle for context. So from the October 4th low into the November 22nd high, we can count a nice completed 5-wave structure. Now, at the end of November, we made note of the fact that from the November 10th low, the trend in growth, specifically the NASDAQ, tech, semis, which is an industry group within tech, the trend there was a lot more mature. And that led us to believe that there was the possibility that that November 22nd high did complete an overall 5-wave motive move from our October low. What I love about the price action that we've seen since that November 22nd high is this. Zooming in on the chart here, we've essentially had a series of 3-wave declines, 3-wave moves. 3 waves to the downside in W, 3 waves back to the upside in X, 3 waves to the downside in Y. Now, when we met at the end of November, we acknowledged the fact that this could actually be an expanding leading diagonal, which simply meant we could visit more significant retracement levels. But what ultimately happened is price action met an equality projection of the initial corrective leg. This is a fairly standard measured move correction. Not only did it meet equality of Y compared to W, that also gave us a net 50% retracement of the October 4th through November 22nd rally. A very appropriate wave 2 stopping point. Since then, take you 1 hour down to the 15-minute chart, you'll see the move up into Monday, a bit of a retracement from this downtrend line resistance. And then yesterday was a solid gap and go move with continuation into the 78.6% retracement of that November to December decline. This is likely 5 up. There's still the possibility that this is actually 1, 2. This is 3, 4, and we go again in 5. But regardless, it's starting to look more as if the correction is complete and that seasonal continuation is a possibility. Now, there is an alternate that I have to at least address, but the fantastic part about this alternate is if this is truly the count, and this would suggest that instead of having a complex completion, we're actually in the process of an overall flat, which means that first 3-wave move to the downside that I just showed you in that green wave 2 is actually just the first leg of the correction. But if this is the case, then we're likely in flat territory given the 78.6% retracement that we've seen. This would imply, if it were to be met with some sort of a catalyst to substantiate another sell-off into month's end, this would imply we move back to the lows, hold the lows, and then see the continuation. So this leaves me with a high degree of conviction to remain bullish into next year. So that's the S&P. I love the move that we've seen here off of the recent measured move equality. I love looking at the Fibonacci relationships that we see here. The actual market low was 44.9512, 44.9757 was a measured move coming off of a 47.40 handle. Quite incredible. And then last but not least, let's take a quick spin through the NASDAQ. The NASDAQ looks very similar in that we do have down here on the 20-minute time frame what can be counted as either a complex or standard ABC correction into a 50% retracement, also seeing fairly solid continuation here. Down on the subdivision of the trend from the lows here in the 15-minute time frame, we didn't meet the 786 retracement yet in the NASDAQ. We could move up here today depending on how we open and then get a little bit of a confirmation retracement move, and that will set us up for the seasonal continuation. Last but not least, the Russell 2000 small caps. I introduced the flat possibility when we met last time. We were aware of the ending expanding diagonal in the wave 5 position, but given the fact that we were teetering on wave count and validation, I wanted to at least provide you with an alternate game plan in the event we broke those key levels. We've since done so, but I still see this as likely just wave 4 prior to that wave 5 continuation into next year. So that's all I've got for you all this morning. Let's go ahead and bring in the trading analysis team. Again, we've got Mr. Todd Gordon of Inside Edge Capital Management from the Advisors Corner. Good morning, gentlemen. How are you doing?
Good. Hey, guys. How's it going?
Doing well. Glad to have you, man.
All of this aside, hey, Alex, when are we going to launch, when are you guys going to launch an NFT service? That's what I want to know.
I love it, man. We've got a fantastic media guy on team, I was going to say. So he has us looking good online. We might need to get him into the NFT space there.
Did you guys see somebody bought like a $2.6 million virtual yacht in the metaverse?
Madness. Absolute madness. Tulip Mania, actually, NFT. I don't know.
We have clients which owns the parks in metaverse.
They own what?
Can you imagine? They own parks. We have a guy as our member. He bought a whole park in the metaverse.
Oh, that's awesome.
You know, I mean, what can you say? I mean, metaverse is really Web 3.0 future. So lots of things going on there.
Yeah. That's awesome.
Huge possibilities.
Hey, that's cool. Hey, thanks for having me, guys. Probably, maybe either forgot who I am or don't know me. I'm Todd Gordon, former CEO of Trading Analysis, founder. This beautiful team's running it. I'm just gonna stop in, if you guys don't mind, just kind of give you my overview here real quick. And you know, I kind of look at the longer time frames, bigger picture, portfolio management as we're running a wealth management business, and just show you what we're seeing from our end, and then hand it back over to the TA team. Promise it won't take up too much time. These guys have a lot of good information to share with you, and I'll just jump in here real quick if that's okay. I don't want to take your valuable time, but it's some interesting things happening in the market. I was going to show you sort of the leadership that I think we're seeing on a larger time frame, as I mentioned, on the portfolio management side, and then obviously the TA team will drop it down to the trading time frames. And I think, you know, what's interesting here is the rotation of the various market cap ETFs that we're seeing. So to start, before we even jump into that, let's look at most simply growth versus value. So I'm going to get rid of all of these and just do...
Hey, Todd, you've got your YouTube window up over your Optima.
Oh, I do?
Just a heads up, yeah. Maybe it's sharing on the wrong screen here. I'll pop back to the team view real quick.
Okay. Sorry about that.
No worries. That's what happens when you got 8 monitors on the desk.
No, that's what happens when you're out of practice. Okay. Let me see if I do this. Does that get rid of it? Oh,
okay, yeah. It was GoTo meeting that was glitching on my end, so you're good to go.
Oh no, I was okay. Yeah, got it. Yep.
All right, take it away.
Okay, cool. So yeah, let's just look at growth and value. So if we just pull up, and you always kind of get confused here. So this is the top 1,000 growth stocks in the U.S. compared to value. This is the monthly rotation, and what we're doing is we're benchmarking this against the total U.S. stock market. So all stocks in the U.S. And you've seen Terry and Bennett show this rotation model. I think it's incredibly helpful. And basically, you're rotating in a counterclockwise fashion for the most part. And as you move up here, this is going to be leading relative to the benchmark, which is the intersection of XY axis. And from, let's call it April of 20 into January of 21, you saw a lot of outperformance of growth versus value. Value was falling away. And now we started to see a little bit of a move in the first part of 21, lower in growth, up in value. And then this is the rotation that a lot of people were talking about, the growth stocks, high valuation tech. It's time to get out of that trade and go back into the reopening trade, like materials and financials and industrials, et cetera. But what you're seeing here is money is now actually flowing. Just watch this hook in growth. Money is now starting to flow October, November, December back into growth. And this is really interesting. The same thing is happening here in values. We're falling out. So if we break it down within growth, which market capitalization sectors are actually seeing most of the money flow? Okay, so if we take value and growth off, let's go top 200 growth. So that's IWY. Let's go mid cap growth, which is IWP, and then you could go Russell 2000 growth, which is your small caps. So all of them are on the right side, but there's one group that is clearly showing outperformance, the same kind of rotation up, and that is in the top 200 large cap growth. Small cap is here in gray, medium cap, middle cap is here. So we're seeing clearly a move into large cap. And if you look in some of the industries, you're going to see that the industries that are leading right now, no surprise, electrical equipment. We have computer hardware, which is up here as well. You're seeing a lot of the large cap tech, and a lot of it's going to be Apple. You saw a huge move back in the semiconductors. You have electrical equipment in there, and then here's computer hardware right here. So you have some pretty good tech names rotating back in, and then you've got the home builders as well, home construction, home improvement retailers. So we have a pretty good diverse allocation between the portfolios. That's not just tech, but there's other movement, as well. So I was going to show you here real quick, just kind of the breakup of the portfolio. I think I'll get to that in 1 sec. And actually, let me just show you a few other kind of market indicators that I'm watching to show that I think the bull market continues, and I think it's going to be more the growth stocks that are pushing us here. This is a spread, LQD. So this is the spread between investment grade corporate bonds over TLH. So this is the 10 to 20 year Treasury bond ETF. So that's the candlestick chart here. So it's corporate grade investment over basically U.S. Treasuries. And you can see since the pandemic low, we've been rallying quite sharply, moving up. Overlaid here is the S&P. So generally, if risk aversion was here in a pending bear market crash, as so many are trying to convince us that that's the case, I think you would start to see a movement really into longer term Treasuries for safety. And you're really not seeing that right now. You're seeing corporates actually outpace, ignoring the divergence in the market. So, I'm continuing to be bullish this market. I showed you guys this before. This is a very simple look of the IVW, which is the S&P 500 growth, compared to IVE, which is value. And I thought this chart really is very telling, showing the rotation into value and out of growth. And then we came right back up to the highs, did a little head and shoulders kind of deal, and then we've just ripped higher now, growth clearly outpacing value. So you look at stocks like I said, computer hardware is moving. I mean, look at Apple, up around 171. It's amazing what this is doing. I mean, I think there was a period when the Nasdaq was down and Apple was up 2.5% yesterday or the day before. I'm forgetting. So it's certainly a very big move into some big cap hardware companies that are producing goods. Not so much, I would say lesser, not so much software companies, but hardware. So let's just take a look. I'll show you the portfolio makeup real quick here. It's not your traditional growth portfolio. We do have some pretty good mix in here and names and in groups you wouldn't expect to see. So this is the growth portfolio that we run, and I was just going to compare it against the holdings in the S&P. So some overweight names that we have right here, obviously technology, as I was just talking about. Technology in the S&P is at we're at 33% in technology compared to the S&P's 26. Okay, we are overweight consumer cyclical, which is consumer discretionary, by quite a large margin, 22.8% weighting in consumer discretionary versus S&P's weighting of 12.6. So consumer discretionary is seeing really good. I did CNBC yesterday. We were talking about sort of the travel, leisure reopening names, and they're actually not doing as well, like Expedia and Booking and Airbnb. We talked about that on CNBC yesterday. You're seeing more I would say the retailers doing very well. Specialty apparel retailers doing well. So there's certainly haves and have-nots within consumer discretionary. It's really important to be in the right stocks right now. Communications continue to lag. They're an 8.7% weighting in our portfolio versus 10 in the S&P, and then we're way overweight in a growth portfolio, energy at 12% compared to 2% in the S&P 500. So still seeing some hangovers, I think, some residual effects of the inflation trade. We'll see if that continues. So just want to show you that, and very underweight defensive. From there, I just kind of wanted to show you this chart. I wrote an article last night that'll be coming out that I think is pretty telling. As I said, running this wealth management company and starting it and really getting to know people well has been very, very educational for me. I ran trading analysis for this 2022 will actually be our 10-year anniversary, and it's amazing how many people have come and gone, and we've got to know people on a fairly good level. But when you get into wealth management, you really get to know people intimately. And I think it's really sad. A lot of people, unfortunately, who are very tuned in, not just from trading analysis, but the short-term trading world, are very afraid or sure of the imminent coming crash. And I think there's so many people who are trying to earn your attention or grab your attention by, unfortunately, putting a lot of fear tactics out there, or the tweet that grabs your attention. And, I think it's important just to look at the S&P. And I can't understate enough, especially with the volatility we just saw the last couple of days. Again, so many people trying to convince you that a crash is coming. And a lot of people who've been way underinvested in the market have missed out on so much money. And I always ran, my portfolio roughly 70% of it was in long-term positions that I managed, but I traded actively about 30% of it. And I think that's really the only responsible way to do it. And, there's a lot of people who I've spoken to and said, well, I'm afraid that when I get in, I'm going to lose all my money. And I've missed out on this huge move post-credit crisis, and I'm afraid I'm going to lose everything. And if you just look back at the S&P 500, and I've got an article coming out that'll kind of go more into detail on this. And if you just take an objective look, you set the emotion aside, you start to develop your emotional intelligence, which is what's required for good trading and investing. What are the chances, guys, you're going to lose everything? And this S&P 500 yearly chart, I think, is really, really insightful. Few undisputable facts about the S&P 500 that began in 1950. One, I think it's up about 27,000%, not including dividends reinvested. The second part is it's never been down more than 4 years in a row. There's 3 significant corrections, the 74, 2000, 2008. You don't see any more than 4 black bars, not down more than 4 years in a row. The other part is it's never in the history of the S&P, the 71-year history, it's never dropped more than 58, 59%. So people come in and say, I'm going to lose everything. Well, unless you're going to set history here and do something that hasn't happened in 71 years, I don't think, somebody who's got high emotional intelligence would say, I'm going to control my fear enough to say the chances of me top ticking this, I think, are probably pretty low. So, it feels very scary when you're in a correction, and, I hate watching your hard-earned profits go away, but kind of put the long-term charts, which I think is really important for an investor, into context and say, look, the last rally that we saw was 2,400%. We saw sort of an ABC correction with tech, housing crisis here. We're only up 600% from this low. And if history is any guide, I think we have a lot further way to go. And again, in each one of these bars, it feels scary, but the longer term trend of this market is up. Please don't be one of those guys who get sidelined. And I've seen portfolios, unfortunately, these people's lives have been impacted forever for not being invested properly. Trade with the right amount of money, but I just want to throw that in front of you guys. So, takeaway: growth continues to go. We are seeing Bennett. I know Bennett and team's going to look into some sectors that were in industries that were showing some pretty good strength with energy and financials, but I still think we're in a long-term tech bull run. I think the technologies that we're seeing are amazing. I don't think most people understand the technologies that are being developed now and how they're going to impact their lives. I hate to see this time as different, but it's much different than the 2000 bull run when a bunch of shell companies went up with no real earnings, insane valuations. I do think this is a different time. Accommodative monetary and fiscal policies that came from the 2000 crash, the housing crisis, and the pandemic only accelerates what's already happening. And that is, I think, the next gen of technologies that are going to change our lives for the better. And I'm not a perma bull, guys. I love trading. On the downside, I love trading bear markets. I traded this bear market. I traded this bear market, did really well in them, and I can do it again. But I'm not bearish. I'm bullish. Okay. Turn it back over to the guys. I hope that was helpful from a big picture perspective. Have a great rest of the day, guys.
Sounds good. Much appreciated, Todd. Thank you so much for jumping in there. Excellent view there on the yearly chart. It's always important to kind of take a step back and put time frame into perspective.
Right.
All right.
Hey, give me 30 more seconds.
You got it.
30 more seconds. Check this out on the Dow. Okay. This right here has also never happened on the S&P, and I forgot to mention this. A candle that took out the low of the last 1, 2, and 3 years has never happened. And on the Dow, it's even more pronounced. But if you look in the history, even going back to the Dow in the 1920s, you had a low in that pandemic that cleared out stops of the last 3 years. You can't find that candle ever in existence. This year is strictly follow through from that long-term technical development, even more pronounced than the yearly Dow. Unbelievable. I don't know if I can bring it up real quick without blowing this thing up on the yearly. Look at that thing. Look at that Dow. It took out the low of 1, 2, 3, almost 4 years ago. That's a stop run below, shaking out weeks. And now we're simply just doing a mean reversion, trend continuation. That candle could be the same on a 15-minute chart. The same dynamic is at work, but that has never been seen before. So anyways, back to you, Bennett.
Much appreciated, Todd. Yeah, that one there on the, it took out the last 3 and actually got pretty well into the body of that, the 4th there. So
Isn't that
very
crazy?
interesting view. It really is. Yeah, that's fascinating. All right. Thank you, sir. Appreciate it. Mr. Terry Long, you ready to jump in and bring us up to speed on what you're seeing in the world of sector rotation? And we will have Alex in just a few minutes when Terry wraps up. He's going to take a look at his macro overview. We, of course, have Crypto Lab as well tomorrow morning, 9 a.m. right here on the Trading Analysis YouTube. All right, Terry, you ready to rock?
Yes, sir. Let's go.
All right, let's hit it.
Hello, traders. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. I want to thank you, Todd, for bringing the longer-term perspective back into view for our clients, as we normally focus on the weekly and the daily rotations here, but going back and looking at those monthly rotations, it's very heartwarming to see that value turned in that monthly. So I think that was very interesting. All right, monthly, let's see, weekly. Okay, back to weekly sector focus. Volatile trading, obviously resulted in 2 up days and 3 down days last week for the S&P, but this is now unfolding into a sharp rebound. Last week was the 2nd week in a row of corrective price action in the markets, with the S&P netting a 1.22% decline. And the NDX down 1.96. I lost my label somewhere. Both indexes traded with higher volatility, as you can see by the range of these candles up and down. That's very indicative of the volatility. Most attempts to navigate this choppy action result in failure, and it's best to sit on the sidelines until calmer seas prevail. And what we've seen now, with a bounce back off of Fridays, both indexes have tested the 50-day simple moving average. You can see the S&P did have one closing day here below the 50 on Wednesday. Friday bounced back. Sorry, is that Friday? That's Thursday. Thursday bounced back. Friday closed again. So the S&P, I've got 2 days here below the 50, and then we get Monday and Tuesday's rally. On the NDX, we actually didn't even get a close below the 50, which I thought was very notable. And so let's take a look. This was last week's sector performance, with communication sector down over 4%. And 10 out of the 11 sectors were essentially negative last week, with utilities being the only thing positive. Fast forward to, whoops, lost my screen. There we go. The fast forward to this week, with Monday and Tuesday's acceleration moves, we've got all 11 sectors pushing higher. I'll unhide this right now. Up 3.27% for the S&P, 3.9% for the NASDAQ, leading by technology, energy, and consumer discretionary. Now, while we have all of these sectors rallying broadly higher, we have the staples, utilities, and healthcare on the downside. Hang on 1 second, I lost my notes too. There we go. All right, so let's switch over here and take a look in terms of relative strength performance. Consumer discretionary, energy, technology, and financials remain the sector leaders, though we are showing a bit of declining momentum in the consumer discretionary here. This is last week's bar. Let's go right there. I'm going to zoom out just a hair. Let's get back to Friday's close. There we go. This is where we were as of Friday. Okay, energy, discretionary, technology, and financials in the leading quadrant still. we noted this rotation here in the real estate sector. The financial sector has been seen with momentum fading for several weeks now as it approaches a neutral status. Now, it has held on to a little bit of positive relative strength condition. Now, look what happens as I rotate into Monday and Tuesdays, and look at the vectors, okay? So we're actually seeing declining momentum in the energy sector. We're seeing some declining momentum in discretionary, but continued relative strength gains. And I think it's very interesting also here to note that the technology vector is actually accelerating back into the leading quadrant, while financials is moving down into the weakening quadrant. And last week, during last Wednesday's webinar, I pointed out that the real estate sector had started forming this new hook down here in the lagging quadrant, and the vector's blue color indicates an improving weekly price trend is formed. And this hook does continue to rotate higher this week. This past week, we also saw continued relative strength improvements in both industrials and materials, and you can see materials continuing to accelerate further to the northeast. But notably, it's more prominent here in the materials than the industrials, though both of these are running in parallel. And excuse me, the broad market is actually pushing staples and utilities also higher. But again, the further we move to the left, the relative strength is dropping off. Now, healthcare is seen with some momentum rally, but continued degradation in terms of relative strength. And poor communications sector just continues to push even deeper here. So one more thing real quick I want to show you guys, and I'll give it back over here to Alex. So back in mid-November, I ran some screens here in Optima, and I pulled up these blue vectors that were indicating the weekly improving trend, and I had done a little bit of a screen in the industrials and the materials. I added a few more stocks just this week because I want you to note these ones that this is from the 19th of November right there, and there is the 12th, right? So back in mid-November, I pointed out this group of stocks here: Union Pacific, this is Masco, Granger, what is this? A.O. Smith and Fortune Brands, Parker Hannifin, and Fastly, Fastenal, sorry. Fastenal. You also got some new ones in here that I added: C.H. Robinson, Illinois Tool Work, Amatec, and IDEX. These red ones were not here in the screen last week. They're the ones I added just recently. But I want you to look where these stocks have pushed since I gave you this information. All of these stocks that were blue have pushed rapidly up here into the leading quadrant. And now we've got another group coming along behind it that at quite a rapid pace. So I'm seeing several stocks in there. Let's pull this up. This is for the materials sector, and I added a few new ones here. This is where they were back on November 12th, and now as we progress all the way up, so several of those like Vulcan Materials, Martin Marietta, they've already, and also this one here called Sealed Air Corp, have pushed up into the leading quadrant. Their weekly price trends have turned to a leading weekly price trend. And we've got another group that, well, it was blue yesterday. It looks like they've turned back red, I guess, for whatever reason. But I did pick up Freeport, Linde, and Ecolabs as looking like they were getting kind of interesting. Nucor. This is Nucor. Look at this hook, this beautiful hook formation here in Nucor Steel that happened. This hook happened on the 26th of November. And look at the acceleration. So Nucor Steel is on the rally there. And this is one of the tools, one of the many tools that we have in Optima that we can use to try to filter out the total stock market and identify those stocks that can give us the exceptional returns in the future. That's all I've got for now, traders. Looking forward to another exciting week of trading. And back to you, Bennett.
Much appreciated, Terry. Excellent work as always. Yeah, very interesting rotations there in materials and industrials on the weekly. Curious to see if we can get some follow through. We'll be keeping our eyes on that. All right, Mr. Alex, sir, we're going to pass the presenter mode your direction. If you could bring us up to speed on what you're seeing, maybe touch base on our gold triangle, give them a little taste of crypto, and if you're interested in full crypto coverage, of course, tomorrow morning, 9 a.m. right here on our Trading Analysis YouTube channel.
Sure, let's go.
All right, let's hit it.
Hey guys, let's go and review a little bit of some of the macro charts. As you know, as we do a whole week, week after week, in a sense of looking what is actually moving these markets in a sense of interest rates and also some of the view in metals and cryptos. So we are still observing this 10-year yield, US 10-year yields chart, and looking for another push up. So I'm still thinking that this will result in yields moving higher up to this 2%, which will be most likely the last move on the upside. I cannot still, of course, claim that because if we start to push further on the upside, maybe we're going to even reach the higher levels, and then we will have to turn this all of the structure into more impulsive movement on the upside. I don't think there is so much probability for that, and the rates going on a 10-year around 3.1 will be really something which will not be very well looked by the whole economies in the world, especially in the US. So my take will be this will be most likely the last move on the upside. Here at 1.2.016, we have equality, which means that the measured move from the lows in the wave A down in B up in C will be actually equal here, and I expect a little bit more movement on the upside before we go in some type of an X wave, which I think most likely is going to be the case, and we are going to stay a little bit in a sideways price movement for the next year or two on the rates. That at least is currently my view. So if we switch to Europe, you're gonna note this is the 10-year Bund chart. It is just inverted of yields. I'm using this chart because it is a wave structure is a little bit more visible. And as you can see, we are still moving sideways. Even the rates are moving down in Europe, although inflation is moving up. We have a ECB and Fed meeting comings before the end of the year, and I think it will be very interesting to see Lagarde's view, and especially the Fed's view, what is going to go, and it's going to be an opening statement for the beginning of the next year. We have heard some of the rumors that the Fed might taper even more on this meeting and give an outlook on the rates for the faster move on the upside. So I'm very curious to see what the Jerome Powell has to say, since that he removed the word transitory that was widely used in the past, and we are not seeing for now that the rates are behaving or inflation in transitory manner. So overall, I still look this as some type of a fourth wave, which means that in a year or two, we might see still deflationary forces starts to move up in this fifth wave. So I'm gonna keep this view as long as this support zone around the previous wave 4 holds. As the dollar index is concerned, the path of dollar index is working pretty nicely. A 5-wave move down from the March COVID start in 2020, small truncation in the fifth wave. From there, we have seen a nice 5-wave structure in the wave A, pullback down in the wave B, and we are now developing most likely a small triangle here before we start to trace out most likely the last move in the dollar, which might take us in January, February of 2022. There is a couple of ratios that we are looking for the possible resistance levels. The relation between A and B up to C in this case is 1618, which is a kind of a rarer occurrence that we see in the relation between A, B, and C. And also we have 786 retracement level. from these highs, which is pretty nicely matching, forming the cluster zone at these levels. And we usually look this as a last resort reversal levels when we look some of the chart development. So I think we are going to go a little bit more of a sideways price action here, and then we will start moving up in this fifth wave up to this 99.23, 99.19, and even 99.85, right to the zone where we have this possible C wave sitting. From there, it is very important we start to see some type of a relatively impulsive move down, breaking this channel, and then a possible pullback, and then a continuation of a dollar possibly on the downside in 2020. 223, which is generally my view as I look other currencies and other charts on the Forex markets, and also when we look gold, silver, and some of the commodity charts, they all depict a very high probability of a dollar reversal and of all of these assets classes going up in 2022-23. So let's look a little bit of metals. So gold chart and silver chart. So gold is still in our famous triangle on the higher time frame. So we did move down from our anticipation that this might be a D wave. Moved out is in a 5-wave manner. So we might see a B and C developing in this E wave. For this wave count to hold, it is very important that post potential E wave, we trace out a 5-wave move upside, which will be definitely a reversal signature, and the probability will highly increase that after a small pullback, we will continue upside on the higher targets for gold between 2,200 and even 2,600. And this picture definitely depicts a possibility that we see in other currencies, although, as I said, and I introduced later after post this triangle observation possibility, if we break this 1676, I just think this will be an intermediary X-wave triangle going down in D, up in E, and then we will see a little bit more lower gold. So this will be the key level here. If we break this level, gold wave count is off, and this is the secondary count that I will look for gold, which will go not so much lower from the intended prices. Usually when you have the X-wave triangle, you will reach 0.618 levels between the relation of Y and W, which comes at 1,593, which will be $100 before the levels of the E wave in the triangle. So that's not a significant fall in the case of this scenario, but from there I expect a big reversal in gold and basically a bull run reaching some of these targets around 2,200, 2,300 in the 2022, 2023. The same picture goes from silver. Silver, after a long consolidation, almost a year, is working. I think this a flat, which will be 3 waves down, 3 waves up, and the diagonal move down in a C wave, which still has a kind of a legs to show on the downside. For now, we are holding this support. As here, there is two distinctive resistance support levels here. And we most likely we will bounce here in a B wave and then continue a little bit lower, maybe a spike or a stop run down to this level between 18 and 20. And from there, I expect reversal for some of the targets on the upside, which are from 35, 40, even to 50 levels on silver. So as regards on cryptos, we have been very vocal to pay attention on cryptos and possible reversal. I've been showing this chart for a couple of last crypto labs. This is just observation which I made on this monthly chart. This is the Bitcoin channel from 2014, which kind of works very nicely if you look the lows and highs. But one of the things which is very distinctive on this chart is this middle line channel line, which actually was behaving pretty nicely if we go above this midline, we continue to rally. And if we made a small red bars here, usually after a 2 bar, we continue to the downside. And if you can see, there has been 2 cases so far from 2014 where we actually continued, penetrated the upper channel, has a little bit of stalling or going up direct, as in these 2 cases. But in most of the cases, this midline acted as a pretty solid resistance levels. As you can see, it has been doing that, 1, 2, 3, 4, and now 5th time that we have that this midline channel actually after 2 bars are continuing to the downside. So this is a monthly bar. Next month open will be very important. If we close and have 2 red bars, this one is now unfolding. That will most likely mean that Bitcoin will, I will not say revisit this global support level, but at least stay in some type of a triangulation before we continue on the upside. And I timed that before some around, let's say February, March, or even April in 2022. Also, if you look this RSI, matching these levels on the midline, it behaves pretty nicely. Once we made the resistance around 70 on the RSI, we turned lower, as we did every time. So this is kind of a thing to observe. If we continue to the downside in this RSI, most likely we will reach 35 to 50 on the RSI, from where we can expect a reversal. Showing the Elliott Wave count, we are still looking for a potential, most likely triangle here. In that case, that will be a wave 4, okay, from the overall structure. So we stay bullish overall on the macro team in the Bitcoin for one more move on the upside. We are still juggling between a couple of wave counts, but triangles are not very easy to spot until they're close to finish. I think most likely this might actually behave as a running triangle, and as you can see here, we might have a little bit more of a consolidation. This 40K acted pretty much nicely in the last fall, and this was a pretty nasty move down, which we announced just 2 days before in the last week Crypto Lab. Unfortunately, people was poised pretty much sizably to expect 100K towards the end of the year, and for now we are not seeing that development, and this move down from 64K down to 40K was pretty nasty to the downside, and I think they hurt a lot of crypto hearts in an attempt to actually expect 100K towards the end of the year. We are at 8th of December. I don't think we will get there until the end of 2021. Most likely, I think this will turn into something more complex in the C wave, up in a B wave. So this 40K line should pretty much tame the downside in the Bitcoin chart for now, and this C wave can go a little bit lower, just poke maybe some stops around let's say 35, 38K, and from there we're going to look for a D wave and E wave, and after that is complete, we might expect the 5th wave on the developments on the upside. So we are still going to stay bullish on cryptos as long as this sideways price movement from this April 2021 highs continues, as you can see, and we are pretty much looking to save our members from the potential this type of events and be patient and wait that this consolidation is finished, and in some form or the other try to put our members on the long side when it's the time. So if you like to see more crypto pairs, join me on the Crypto Lab tomorrow on our trading analysis channel, and hit the like button, guys, for us. So back to you, Bennett.
Thank you, Alex. Much appreciated. Excellent analysis as always. Yeah, he was speaking of that expected move directly to 100,000. When we were approaching that 65 to 70K area previous high that we had earlier this year, you were fairly vocal about the fact that we did have some key fib resistance there that could yield this corrective retracement that we're now currently trading in. So excellent work. If you're interested in more, of course, join us tomorrow. Check us out, tradinganalysis.com. Alex runs the excellent crypto service, steering our clients in the right direction. Thanks again for tuning in. We appreciate you all taking time out of your Wednesday morning. Tune in tomorrow. Subscribe with notifications if you did enjoy the content. It lets the YouTube algorithm know and distributes it accordingly. Thanks again, members. We'll see you in about 15, 20 minutes for the member webinar. Traders, investors, we'll see you guys next week, and we'll see you on tomorrow morning's live stream. Any final words of wisdom, team? All right.
Yeah, what is interesting, Bennett, is that the same levels we looked also held this time. So we looked before in May, the same thing happened exactly this, around the same levels from 60 to 70K. So a pretty tough zone to go over for the Bitcoin, and I think we're going to see more consolidation. So
definitely, and we continue to remain bullish. The old saying goes, the market goes to the most obvious places in the least obvious ways possible. This is a great example. We do think 100K is certainly achievable. Got to get through this correction first. All right, Terry, Alex, excellent work, gentlemen. We'll see you guys next week. Have a good one. Take care.